Hi there. If you want to know the difference between saving, investing and speculating, you've come to the right place. In the next 5 minutes, I'm going to give you a crash course. I'm Jason Butler, and I'm a professionally qualified personal finance expert with 30 years experience. So why should you care about this and listen for the next 4.5 minutes? Well, it's simple. Inflation erodes the purchasing power of our money, and so therefore we need it to at least keep up with inflation. And secondly, most of us can't save enough or haven't saved enough to meet all our lifestyle goals, and we need additional returns over and above inflation. And that's what this is all about. Saving is where you put your money in a bank or building society account, your capital is secure, and you get interest. But generally speaking, over most periods of time, your money is devaluing relative to inflation. So if inflation is at 2% and you're getting 1% interest, your money is being able to purchase less and less as time goes on. So savings accounts are great when you need to get your hands on money in the short term and you can't risk the capital going up and down. So say your emergency fund or building a deposit for a house in a year or two, or where you're not bothered about inflation and you don't care if it devalues because you've got more than you need. Now let's put aside property investing because that's more of a business, and I want to focus on investing in companies, businesses who are providing products and services. So when you invest, you are buying a part share in one or more companies, whether that's directly buying the company's shares on the stock market or whether you're buying through a fund. And when you invest through a fund, you are buying a small part of lots of companies that are providing those products and services. And those companies make a profit and they pay that profit out as dividends, and they reinvest some of those profits to make profits in the future. Now, direct investment is where you're investing directly in one company's shares like Tesla or Facebook or Berkshire Hathaway, and they are quoted on the stock market. And they can be very good, but the problem is if that sector doesn't do well, you can find that your returns are very poor. But equally, they can be very high. Most people would be investing in a fund, and that's where you have a part share in thousands of different companies from around the world, different sectors, different areas. And I always advocate investing in a global equity index fund because it's low cost, it's fully diversified across lots of companies, and you don't have to worry about it. And when you're investing like that, you've got a part share in those future profits of those companies in the form of the dividends they pay out to you as the investor and the future earnings that they're going to grow from expanding their products and services and improving what they offer. So in the short term, the stock market, which is where companies are listed, represents buyers and sellers. And in the short term, that's like a voting machine. When there's more people who want to invest, the prices go up. When less people want to invest and more people want to sell, the price goes down. But in the long run, and we're talking 10, 20, 30 years, the stock market's more like a weighing machine. And over time, although markets go up and down, eventually the effect of dividends and earnings growth does what we call compounding. It grows on itself. And therefore, over time, as long as you reinvest dividends and any income arising from your investments, your investment should continue to grow far higher, not just over what you invested, but also much higher than inflation. So even though stock markets will always be volatile, and sometimes they can fall 30, 40% in literally a week or two, over the long run, they have historically produced good returns relevant to any other kind of investing and in relation to inflation. So the real risk of investing in equities is that from day to day they go up and down in value, and that the future return is uncertain. It could be very, very high. Historically it's been sort of 7-8% over inflation, or it could be equal to inflation, or it could be less than inflation. No one knows. But if you have faith in the future and faith in capitalism and believe we're not going back to living in mud huts and watching black and white telly, then the chances are capitalism is going to give you a favourable return over inflation in the very long run. The other risk you have to think about is what's the chance of you having a complete loss of all of your capital? And the chances are very, very low. Not saying it can't happen, but it's very unlikely. Now, speculating is when you put money into something that has a very high chance of you losing all that capital. And in return for that, you hope to have a really big payoff. So that's what we call putting money into something that can either kill you in the form of losing all your capital, or you can make a killing 4, 5, 6, 10 times what you invested. And a classic example of speculation is Bitcoin and cryptocurrencies, because they don't actually produce anything. They are a means of exchange, but they only go up in value because other people believe there is a value to investing in them. Now, I'm not saying don't do speculation, but only do speculation with money that you are able to and willing and can afford to lose, and in things that you have some knowledge of. So, there you have it. Savings for the short term, or where you don't worry about inflation. Investing is taking a stake in companies that provide goods and services. It's a voting machine in the short term and a weighing machine in the long run. And speculating is where you're hoping for a big payoff but expect to lose all your money. So from my mind, get your emergency fund right and start investing regularly 15% of your money into stock market based investments for the long run, and be very careful about speculating. See you next time.